Welcome back. In the previous video, you learned about perfect capital markets and our basic notation. Let's use it. In this video, we begin with calculations about holding returns and the difference between percent prices changes and total returns. Now, this video is still somewhat slow and gentle, just reviewing subjects you already know. Again, I want to make sure we stay self-contained and that everyone is on the same page. As the course progresses, there will be a lot more and more unfamiliar subjects. So here comes the fundamental formula of finance. If you buy an investment asset at price P0, you get interim dividend payments of D01 paid out at the end, sell it for P1, then your holding rate of return is P1 plus the dividend in the interim minus P0 divided by P0. And very often what people will do is they will take the minus P0 divided by P0 and make minus 1 at the end. And I'll do that many times during this course. The income yield component is the dividend divided by P0. Now, for stocks, that's the dividend yield. For bonds, it can be something like a coupon yield. For real estate, it could be something like a rental yield. For you're living in something, could be something like a convenience yield. The capital gain is P1 minus P0. The percent price change is P1 minus P0 divided by P0. And the total rate of return is the percent price change plus the interim payment dividend yield. Now, I'm going to ask throughout this class many times questions. And I'm going to try and put the questions up in red, like, what is your answer or guess to a particular question? So the question will be in red. I want you to answer the question, ideally with pen and paper and a calculator, before you go on to the next slide. Take the time to think about your answer. When you go on in the video, you should then compare your answers to the solutions that follow. For example, if you invest $5 and you will receive $8 in 10 years, what is your holding rate of return? This is when you pause and calculate your own answer, and afterwards you continue.
Please pause this video now, answer the question on a piece of paper, and then continue.
Here, your rate of return is 8 minus 5 divided by 5, so that turns out to be 60%. Well, that was easy. I promise you, there's going to be harder questions in red. If the rate of return is positive, can the price change be negative?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the rate of return is P1 minus P0 divided by P0 plus D1 divided by P0. What you want is R1 to be positive and P1 minus P0 to be negative. So what we will need is a very large positive D over P0 to drive a wedge between the two. For example, $100 in P0, you buy it for that, $91 in P1, and $10 in D01. So this is going to give you a rate of return positive of plus 1% with a percent price change of minus 9%. The way I think about everything, whether it's finance, economics, broader, I always try to think in examples, concrete examples. I always find this to be the easiest way for me to think about this. I know there's other people that think differently. For them, formulas may work well. For me, it doesn't. For me, it's the examples that work well. If the rate of return is negative, can the price change be positive?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the rate of return is still the same formula. In order for this to work, you would have to have a negative dividend or coupon yield. But because dividends, coupon yields, have to be positive, the answer to this question is no. Can a rate of return be negative in our perfect certainty, perfect capital market?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, we already know all realized returns ahead of time. In this case, every rate of return is more like an interest rate. In this case only, if you are allowed to abstain, you would simply not invest. Therefore, in this case only, no. Of course, in the real world, negative rates of returns, in which case they aren't necessarily interest rates, are very common. There's a lot of investments on which you can lose money. Can a risk-free interest rate be negative in the real imperfect world? Not the perfect capital market and an imperfect capital market.
Please pause this video now, answer the question on a piece of paper, and then continue.
The way the question is phrased means we kept the perfect certainty assumption, but took away the perfect capital markets assumption. Of course, as in the previous question, by convention in all of finance, these are nominal quantities. They're not real. So, of course, real interest rates are actually often negative in the real world. Now, you can still store all your cash under a mattress instead. So, typically, you shouldn't find such situations as this. But, well, if you're not in a perfect capital market, maybe there is a tax on this. So maybe that is possible. So it's not exactly clear. Let me step back for a moment here. Without a mattress, you may have to pay for vault services. Let's say you have $1 million. It's not so easy to store $1 million anymore. Now, there's many dictators and criminals that want to squirrel away money in places like Switzerland at negative interest rates. Why? Because they are afraid when they get overthrown, the people are going to come into the palaces and just take all the money away. So they are willing to pay money, even without interest rates, just to be able to have access to it afterwards, even if it's at a negative interest rate, even if they don't make that much money. And Switzerland, by the way, is just now one of many places that allow you to do that have numbered accounts. There is other countries that allow it to do it as well. But of course, Switzerland is the most prominent. There's another case actually in which we had negative interest rates. And that's an interesting one, and one that is not so obvious. So it turns out that the Federal Reserve Bank of Japan, for much of the 2000s, and the United States after the Great Recession, really wanted to stimulate the economy. How do banks do this? Well, what they do is they want to give money to banks at very, very low rates so that the banks have the money and then they will lend it out to other companies. That was the idea. But interest rates were already close to 0%. So what the Federal Reserves did is they actually gave money to banks at negative interest rates. They would pay them to have extra money on their balance sheets that they could just hand out in loans to their clients. Of course, they don't do that in cash anymore. It's just something in a computer that tells you you now have this money that you can lend out. So you would think this is very easy. Now these banks have all this money and they should lend this out to customers. Turns out it was a lot harder than most economists would think. So the Fed paid a lot of money to these banks. They hoped they would relent the money. But what happened is the bank said, oh my God, I don't trust these customers and businesses anymore. We are in sort of a recession. They may not pay back. Let me take that money and deposit it in treasury bonds. So the Fed would give them money for a negative interest rates, pay them to do this, and they would take the same money and just redeposit it again. And it was actually the same also for many of these firms. They would say, oh my God, I really need a buffer here. So I'll take the loan that the bank will give me, but instead of investing the money and building a new factory or hiring more people, I'm going to take that money and immediately deposit it in the bank again. So that turns out to be somewhat of a problem. It happens sometimes during recessions. We may get deflation. There's all sorts of crazy stuff that can go on. It's not normal. but in abnormal circumstances, it can happen. Now, what is today's prevailing risk-free interest rate? Please look at a few free websites. And by the way, up there, I've actually put a QR code so you can look it up and you can get to at least one of these websites. So the website I use for this very often is Bloomberg. They have a lot of interest rates, many different kinds of interest rates. This is because the real world ain't a perfect capital market without uncertainty, where there's just one interest rate. So there's many different interest rates. The simplest ones are typically close to the US Treasury. They are the one closest to having no uncertainty whatsoever. In this sense, we're really discussing those treasuries right now. Now, we're going to do the fundamental formula of finance again. We're going to turn around the fundamental formula. If you buy an asset at price P0 and you earn a rate of return of R01, then what will you have in the future? That's called the future value. If you invest $55,000 at an interest rate of 3.5 full points above the 5% prevailing interest rate, notice I'm using the point concept, which I just taught you about, and there is no interim yield, no dividends, no coupons, what will you receive in return at the end? Well, the interest rate is 8.5%. Thus, you will end up with $59,675. That is called the future value. If your cash, $5, will earn a rate of return of 250% invested over 30 years, how much money will you have at the end? The 250% is not per year. That's invested over 30 years total. You get 250%. How much money will you have at the end? You will have $17.50. If you have $5 and you earn a rate of return of 20% in the first year and a rate of return of 20% the next year, how much money will you have? No. Take the 5, multiply it by 1.2, multiply it by 1.2 again, $7.20. This is compounding. It includes earning interest on the interest. If you have C dollars and you earn a rate of return each year for T years, how much money will you have in T years? Little bit too obvious perhaps. C times 1 plus R to the power of T. That's it for this video and for the basic definitions related to interest rates. I know. You probably still knew most of this already and it was still too boring. I'm sorry, forgive me. It was boring and for some of you, perhaps too easy. But bear with me. It's only chapter 2. Trust me, after chapter 2, I will accelerate. In the next video, we'll move on to compounding and from there to present values. See you soon. Bis bald.
Where is capital of Russia?
You tell me.
In Swiss bank account.
Ha ha ha, not funny, Vlad.